Right now, tonight, while you're watching this video, the Internal Revenue Service is running a calculation on your 2025 income that will determine exactly how much money is removed from your Social Security deposit every single month, starting January of 2027. Not a future calculation, not something that depends on what you do next year, a calculation built on the income you already earned, the accounts you already hold, and the decisions you already made or did not make in 2025. The mechanism is called the IRMAA lookback. It is written into the Medicare statute. It uses your modified adjusted gross income from exactly 2 years prior to calculate the income-related surcharge added to your Medicare Part B and Part D premiums. Your 2025 income sets your 2027 premiums. Your 2025 tax return, the one sitting in a filing cabinet or on a hard drive right now, is the document the Social Security Administration will read when it calculates how much to deduct from your first 2027 deposit. And it is not just the IRMAA surcharge. The same 2025 income is being used to calculate how much of your Social Security benefit is subject to federal income tax next year and the year after that. It is being used to determine whether you crossed an income threshold that phases out the senior bonus deduction from the One Big Beautiful Bill Act, a $6,000 deduction for every retiree over 65 that was written into law for tax years 2025 through 2028. And that gets reduced and eventually eliminated if your income climbs too high. And it is being used to set the baseline from which your required minimum distributions, if they have already started, will escalate every year for the rest of your retirement. 7 accounts, 7 different ways that what is sitting in your portfolio right now is either creating that 2027 tax liability or can still be restructured before the window closes. The window does not close in 2027. It does not close when you receive the Social Security Administration's letter telling you your deposit changed. It closes on December 31st of this year, because December 31st is when your 2025 modified adjusted gross income is finalized, when the accounts are valued for next year's required distribution calculations, and when the last day of the One Big Beautiful Bill conversion window for this tax year passes. After December 31st, the 2025 calculation is complete. What it produces is what the Social Security Administration uses for 2027. There is no appeal for income that was earned. There is no retroactive restructuring. What you did with these 7 accounts in 2025 is the answer the system already has. This video covers all 7, the specific dollar thresholds for each one, the exact mechanism by which each account either contributes to or reduces the 2027 liability, and the specific action for each account that is still available in the months remaining this calendar year. Before anything else, this video is educational only. Nothing here is tax or financial advice, and the specific rules, thresholds, and eligibility requirements vary by state and by individual situation. So verify everything here with a qualified professional before acting. That disclaimer is here because it belongs here, not because it reduces what I'm about to show you. Now let me tell you about Frank and Margaret. Frank DeLuca is 69 years old. He retired 2 years ago after 36 years as a civil engineer for the city of Columbus, Ohio. He receives a city pension of $31,200 per year. He and his wife Margaret, 66, former dental hygienist, retired 18 months ago, receive combined Social Security of $33,600 per year. Frank has a traditional IRA with a balance of $740,000 that he has never touched. Margaret has a 403B from the dental practice where she worked for 26 years with a balance of $184,000. They have a joint taxable brokerage account at Vanguard worth $214,000 that they opened in 2003. Frank has a high-yield savings account he moved $260,000 into 14 months ago when the bank offered 4.8%. And Frank's mother passed away in 2021, leaving him an inherited traditional IRA worth $136,000 that he has been managing without fully understanding the distribution rules. 6 accounts before we add the 7th. 7 months ago, Frank's daughter, Rebecca, 39, works in hospital benefits administration in Cincinnati, came to visit for the weekend and asked Frank and Margaret one question while they were making coffee on Saturday morning. She asked, "Have you ever looked at what your income picture looks like in 2027, specifically what happens to your Social Security deposit and your Medicare premiums when your father's IRA starts requiring distributions at 73? Frank said their financial advisor had mentioned the required distributions. He said they knew the money would eventually have to come out and they would pay taxes on it. Rebecca said, "It is not the taxes on the distribution that I'm asking about. It is everything else the distribution activates." 2 weeks later, Frank and Margaret sat with a fee-only CPA in Dublin, Ohio. She spent 3 hours with them on a Saturday morning, and at the end of that session, she said something Frank told me later he replays constantly. She said, "Based on the way your accounts are currently structured, your 2025 income, the year you are in right now, will produce a 2027 Medicare premium that costs you and Margaret combined approximately $12,000 more per year than it would if you restructure 3 of these 7 accounts before December 31st. $12,000 per year from accounts they already owned, structured the way they have always been structured, doing nothing different from what they have always done. Frank said, "How is that possible?" She said, "Because the income in these accounts is not being managed against the threshold. It is just sitting there generating taxable income every year automatically. And that income is what the Social Security Administration will read when it sets your 2027 deductions." Frank asked what he could do. She said, "You have 7 months. Let me show you what each account looks like and which ones we can still move." That is the conversation this video is having with you right now. 7 months, 7 accounts, the window is still open. Account number 1, the Traditional IRA. The Traditional IRA is the account that most people think about first when required minimum distributions are mentioned, and it is the first of the 7 because it is the one with the highest leverage, meaning a small change in strategy produces the largest change in the 2027 outcome. Frank's Traditional IRA balance is $740,000. He is 69. He has 4 years before the required minimum distribution at age 73 activates under the Secure Act 2.0 rules that apply to anyone turning 70. 3 on or after January 1st of 2023. 4 years is a significant window. It is 4 tax years in which the mandatory distribution has not begun, 4 years in which the account is not required to generate taxable income, and 4 years in which the income Frank does receive, pension and Social Security, is at or near the lowest taxable level it will ever be in his retirement. Here is the specific mechanism of what happens to the 2027 bill when Frank does nothing with the IRA for the next 4 years versus what happens when he acts. If Frank does nothing, his 2025 income includes his city pension of $31,200 and the Social Security inclusion from the provisional income formula. Before any IRA distribution, his modified adjusted gross income for 2025 is approximately $44,000. Pension plus 42.5% of Social Security income that crosses the provisional income threshold at their combined income level. At $44,000, Guy, Frank and Margaret are below the IRMAA first-tier threshold of $212,000 for married couples filing jointly in 2026. Their 2027 Medicare premiums will reflect the standard rate with no surcharge. They are safe on the IRMAA front for now. But here is where the Traditional IRA creates the 2027 problem even before Frank turns 73. The 4.8% interest on Frank's $260,000 high-yield savings account, which we will cover in account 4, is already generating $12,480 of ordinary income per year that lands directly in his MAGI. Add that to his pension and Social Security inclusion, and Frank's 2025 MAGI is no longer $44,000, it is approximately $56,500. Still below the IRMAA tier, still safe for 2027. But, and this is the cascade that the CPA showed Frank, at age 73, his first required minimum distribution from the $740,000 IRA will be $740,000 divided by 26.5, which is $27,924. Add that to his existing 2027 income. Picture. Pension $31,200, Social Security inclusion already at 85%, because his provisional income will have crossed the $44,000 married filing jointly threshold. Savings account interest $12,400, required distribution $27,924, and combined MAGI for 2027 approaches $104,000, still below the $212,000 IRMAA threshold. But here is what the CPA calculated that Frank had never seen: the combined effect of the provisional income cascade on Social Security taxation. In 2027, if Frank is in full distribution mode, 85% of his and Margaret's combined Social Security benefit of $33,600 is taxable, $28,560. That is taxable income on money they already paid Social Security taxes on during their working years, being taxed again as retirement income because the provisional income threshold of $44,000, written into the tax code in 1983, and never adjusted for inflation one single time in 42 years, is so low that the majority of retired middle-class Americans cross it automatically. The federal tax on their 2027 income, pension plus required distribution plus Social Security inclusion plus savings account interest, at their marginal rate, approximately $18,400. Before the IRA distribution started, their federal tax on the same pension and Social Security was approximately $3,100. The IRA distribution added $15,300 in additional annual federal income tax on income streams they were already receiving, not tax on the new income, tax on the old income that the new income forced into the taxable zone. This is the cascade. Now here is what changes when Frank uses the 4 years he still has before the distribution begins. Frank's current taxable income before any Roth conversion is approximately $31,200 from his pension, plus the Social Security inclusion at 50% of the benefit that falls into the lower tier of provisional income. After his expanded senior standard deduction of $36,300 for a married couple both over 65, his actual taxable income is close to zero. He is at the very bottom of the 10% bracket, with approximately $94,300 of 12% bracket space above him before he even touches the 22% tier. Every dollar converted from the traditional IRA to a Roth IRA in the next 4 years, while he is in this low-income window, before the required distributions begin, before the savings account interest is pushing him toward a threshold, costs 12 cents or less in federal tax. Every dollar converted permanently exits the required minimum distribution calculation. It never forces a distribution at 73 or 75 or 80. It never lands in Frank's provisional income and forces additional Social Security into the taxable zone. It never contributes to the magi that the Social Security Administration will read when it sets his 2027, 2028, or any future year's Medicare premiums. It grows tax-free in the Roth. It passes to Margaret, tax-free when Frank dies. It never generates a required distribution in either of their lifetimes. The CPA recommended a disciplined conversion of $85,000 per year for the next 4 years while staying below the IRMAA tier and within the 12% bracket. Total converted, $340,000. Total federal conversion cost at 12% blended, approximately $40,800 over 4 years. Remaining IRA balance subject to required distributions at 73, approximately $430,000. First required distribution from $430,000, $16,200, down from $27,900. Annual provisional income impact, significantly lower. Annual additional Social Security taxation, triggered, significantly lower. Medicare IRMAA exposure, lower every year for the rest of Frank's life. The conversion cost $40,800 once. The cascade it prevents would have cost $15,300 per year in additional federal taxes for the rest of Frank's retirement. The payback period on the conversion cost, approximately 2 years and 8 months from the first distribution year. But here's the detail that changes everything about the timing of this decision. The senior bonus deduction from the One Big Beautiful Bill Act, $6,000 per person over 65, $12,000 for Frank and Margaret combined, is available for tax years 2025 through 2028 only. It is not permanent. It expires after the 2028 tax year unless Congress extends it. For the next 4 tax years, Frank and Margaret have $12,000 additional dollars of deduction that effectively expands the lower bracket space available for Roth conversions. After 2028, that space narrows. The conversion cost in 2029 and beyond will be higher because the deduction floor is lower. The window for the cheapest possible conversion cost is not indefinite. It is exactly as long as the OBAS provisions remain in effect. 4 years, 7 months already used. 3 years and 5 months remaining before the conversion window is fully open, with each year after the OBA expires being progressively more expensive. The account that looks safest, the one that has been growing quietly, untouched for 36 years, is the one generating the largest portion of the 2027 liability that Frank does not yet know he has. Account number 2, the 403K and 403B. Margaret's 403B is a different animal from Frank's traditional IRA in one specific and important way. It is subject to the same required minimum distribution rules. Age 73, same uniform lifetime table divisors, same ordinary income treatment, but the distribution timing has one additional layer of complexity that most financial advisors do not address in the first meeting. When Margaret left the dental practice 18 months ago, her 403B account was still held with the practice's plan administrator, a major insurance company that administered the plan for the practice. She has not made any changes to the account since leaving. The account has been sitting there, still inside the employer plan, still subject to the plan's investment options and fee structure, and, critically, still subject to the plan's distribution rules, rather than the more flexible IRA distribution rules. Here is why that distinction matters for the 2027 calculation. Traditional IRAs give Margaret the ability to take distributions in any amount at any time after age 59.5, with only the required minimum distribution rules applying after age 73. She controls the timing, the amount, and the year in which income appears on her return. If she rolls the 403B into a traditional IRA, she has that same control. If the 403B stays inside the employer plan, the plan document governs distributions. Some plans require lump sum distributions when a participant terminates employment past a certain age. Some plans have default distribution elections that activate at required minimum distribution age without an explicit opt-out. Some plans limit the distribution options to specific payment schedules that may not align with the tax-optimal strategy Margaret and Frank are trying to execute. The rollover from the 403B to a traditional IRA, and from there into the Roth conversion strategy, is not just administratively cleaner. It is the mechanism that gives Margaret full control over when income appears on their joint return and in what amount. The rollover itself is a non-taxable event. The check goes from the plan administrator directly to the IRA custodian. No income is recognized. No tax is triggered. The account moves intact, and from the day the rollover is complete, Margaret has the same flexibility on her 403B balance that Frank has on his IRA. Now here is the specific 2027 implication for the 403B balance of $184,000. If Margaret rolls the 403B into the traditional IRA this year and the combined IRA balance that Frank and Margaret manage for Roth conversion purposes becomes $824,000, Frank's $740 plus Margaret's $184, the total conversion capacity and the total future RMD liability are now under one coordinated plan instead of two separate institutions operating independently. The CPA who worked with Frank and Margaret added the 403B rollover to the conversion schedule in year 2 of the 4-year plan, after the first year of conversion established the process and the IRA custodian relationship, and folded it into the annual conversion target without pushing either Frank or Margaret into a higher bracket in any single year. If the 403B is not rolled over and it stays in the employer plan, two things become likely. One, the plan may generate a required distribution at 73 that is not coordinated with Frank's IRA distributions, pushing both distributions into the same calendar year and potentially triggering IRMAA in a year where the combined distributions plus pension plus Social Security would not have crossed the threshold individually. Two, the plan's distribution rules may not allow the partial distribution strategy that the Roth conversion plan requires, forcing a larger distribution in a single year than the optimal tax strategy calls for. The rollover costs nothing. It requires a form from the 403B plan administrator and a receiving IRA account. For most participants, the entire process takes 2 to 4 weeks. There is no income event. There is no taxable moment. There's only the transfer of an account into a structure where its distribution can be timed to the exact year and amount that the tax strategy requires. That is the 403B action. Execute it this year, before December 31st, so that the account is inside the IRA structure before the 2025 income calculation closes. One additional note on the 401k specifically, because most people watching this video have a 401k from a previous employer rather than a 403b. Everything I just described applies identically. The rollover process is the same, the non-taxable treatment is the same, the coordination benefit is the same, and the 2027 deadline implication is the same. If you have a 401k from a previous employer that has been sitting in the plan administrator's system while you no longer work at that company, the rollover conversation needs to happen this year. The account exists in a structure that gives you the least flexibility and the least coordination with your overall income picture, and the only cost of fixing that is a phone call to the plan administrator. Account number 3, the traditional pension. This is the account that catches Frank most off guard when the CPA walks through it, because Frank has never thought of his pension as a problem. The pension is the secure thing, the guaranteed income, the reason he spent 36 years with the city of Columbus instead of working in the private sector where the money would have been better, but the retirement security would have been less certain. The pension is not a problem in isolation. The pension becomes part of the cascade because of how it interacts with the provisional income formula for Social Security taxation. And because of a decision Frank was given the opportunity to make at retirement that most retirees get wrong and almost none of them fully understand when they make it. Let me explain the provisional income interaction first, because this is the mechanism that is setting Frank and Margaret's 2027 Social Security tax position, even before any IRA distributions arrive. Their combined Social Security benefit is $33,600 per year. 50% of $33,600 is $16,800. Add Frank's pension of $31,200. Their provisional income before any other income sources, $48,000. That is above the married filing jointly upper threshold of $44,000. 85% of their Social Security benefit is taxable from the first day of retirement, not because of anything unusual about their situation, but because the threshold that triggers the maximum Social Security taxation rate has not been adjusted since 1983, and their pension alone is sufficient to push them above it. Their combined annual federal income tax on pension plus Social Security inclusion, approximately $5,800. That is the baseline before any of the other 6 accounts generate additional income. That baseline is already set, and there's nothing to do about it, because the pension income is fixed and cannot be restructured. What can be restructured is the rate at which every additional dollar of income from the other 6 accounts lands on top of that base. Because Frank and Margaret are already at 85% Social Security inclusion, already at the maximum taxation rate for their benefit. Every additional dollar of income from the IRA, the savings account, the brokerage, or the 403B does not trigger additional Social Security taxation. The cascade is already fully activated, which means the Roth conversion strategy, executed while they are in this pre-distribution window, converts dollars at the 12% rate without creating additional Social Security taxation on top, because the Social Security tax cascade has already maxed out. This is the specific opportunity the pension creates that a lower-income retiree without a pension does not have in the same way. Frank and Margaret are already above the threshold. The threshold cannot be triggered more than once. Every conversion dollar they execute this year costs 12 cents in federal tax and permanently exits every future. Income calculation. The pension paradoxically makes the conversion strategy more efficient because there is no incremental Social Security cascade cost attached to the conversion income. The cascade is already fully applied. Now, the lump sum decision, because this is where pensions are most frequently mismanaged at the moment of retirement and where the 2027 consequences are already set for Frank and Margaret, but where they are not yet set for someone watching this video who is approaching their retirement date. When Frank retired from the city of Columbus, he was given a choice. He could take the pension as a monthly benefit for life with a survivor benefit for Margaret. Or he could take a lump sum of approximately $417,000 and invest it himself. He took the monthly benefit. This was almost certainly the right decision for his specific situation. But the analysis most retirees get before making this choice is inadequate to the actual decision. The lump sum, if taken, would have been treated as ordinary income in the year of receipt unless rolled over into an IRA within 60 days. If Frank had taken the $417,000 lump sum and rolled it into his IRA without tax, recognition, his IRA balance today would be approximately $1,157,000 instead of $740,000, and his required minimum distribution at 73 would be $43,600 instead of $27,900. The rollover would have preserved the capital. It would also have dramatically increased the required distribution amount and the cascade intensity. The monthly pension, by contrast, generates predictable income that has no future RMD attached to it, no acceleration risk, and no account balance that grows with investment returns. It is simpler and more predictable in terms of the distribution cascade. Though, as Frank's situation demonstrates, it still contributes to the provisional income picture that has already pushed 85% of Social Security into the taxable zone. For anyone watching this who is approaching retirement and has a pension lump sum decision in front of them, the analysis must include the provisional income impact of a large lump sum IRA rollover on the required minimum distribution calculation and the IRMAA trajectory, not just the comparison of lump sum investment returns versus monthly benefit certainty. The monthly benefit wins on certainty. The lump sum rolled to IRA wins on survivor flexibility. The analysis that determines which wins on total lifetime tax efficiency requires modeling both paths against the IRMAA thresholds over 20 or more years of projected retirement income. That analysis is not the one most pension advisors deliver before the election deadline. Account number 4, the high yield savings account. 14 months ago, Frank moved $260,000 from a standard savings account, earning 0.4% into a high-yield savings account at the same bank that was advertising 4.8% annual percentage yield. He made a smart banking decision. He made it without realizing the tax consequence of that decision in the context of the IRMAA look-back. Here is the exact mechanism. 4.8% on $260,000 generates $12,480 of interest income per year. This interest is reported on a Form 1099 INT from the bank. It is ordinary income. It lands on line 2B of Frank's federal Form 1040 and increases his modified adjusted gross income by $12,480. For tax year 2025, Frank's May GI before the savings account interest, pension $31,200 plus Social Security inclusion at the 85% rate. Let me calculate this properly. The Social Security inclusion is $28,560, which is 85% of $33,600. His provisional income was already above the upper threshold, so total May GI. Before savings interest, pension $31,200 plus SS inclusion, $28,560 equals $59,760. Add the savings account interest, $12,480. Total 2025 Magi, $72,240. The IRMAA first-tier threshold for married couples filing jointly in 2026 is $212,000. Frank and Margaret are well below it for 2027. But let me show you what Frank's Maggie picture looks like in 2027 after the IRA distributions begin. Assuming he has done nothing to restructure and the savings account is still generating $12,480 per year. Pension $31,200, Social Security inclusion $28,560, savings account interest $12,480, IRA required distribution $27,924. Combined 2027 Magi $100,164, still below the $212,000 married threshold. But here is where the single filer cliff enters. Because if Margaret survives Frank by 5 or 6 years, which is statistically likely, she is filing as a single filer. The IRMAA first-tier threshold for a single filer in 2026 is $106,000. At the IRMAA income levels, we just calculated Margaret as a single filer, receiving her own Social Security, the pension survivor benefit, the IRA distributions, and the savings account interest, may approach or cross the single filer IRMAA threshold in years when one additional income event occurs. A Roth conversion in the same year as the distribution, a home sale, a larger than average distribution because of a missed year. Any single income spike in a year when Margaret is a single filer can push her over a threshold that would not have been crossed under married filing jointly. And the surcharge that results applies for the 2 years following that income spike. The savings account interest is the background noise that sits under every IRMAA calculation. $12,480 of annual ordinary income that has no floor and compounds with the account balance if not spent. Now here is the number the bank never tells you. Frank is at 85% Social Security inclusion already. His marginal rate on the savings account interest at his income level is 22% federal plus an Ohio state income tax of approximately 3.75%. Combined marginal rate, approximately 25.75% on the interest income. His net return on the high-yield savings account after the marginal tax, 4.8% gross minus 1.2, 3%. Effective tax drag equals net return approximately 3.57%. A money market fund holding 3-month Treasury bills currently yielding around 4.3% would generate interest that Frank can control the timing of more precisely, and certain municipal bond investments from Ohio issuers would generate interest that is federally exempt and Ohio state exempt, producing a lower gross yield with a higher after-tax equivalent for Frank's specific situation. The action for the savings account, calculate the optimal balance, the amount Frank can keep in the high-yield account without pushing his 2025 Magi above the level that creates strategic problems when combined with the other 6 accounts, and move the excess into instruments that generate either tax-deferred income or tax-exempt income. The calculation takes the available 2025 bracket space, subtracts the pension and Social Security inclusion, and divides the remaining headroom by the savings account interest rate to find the maximum balance that stays within the desired income ceiling. For Frank, his total Magi from fixed sources, pension and SS inclusion, is $59,760. His 12% bracket tops out at approximately $94,300 for married filing jointly. His remaining 12% bracket headroom, approximately $34,540. At 4.8% yield, the maximum savings account balance that uses only the 12% bracket space without contributing to higher bracket exposure, $34,540 divided by 4.8%, which is approximately $719,000. Frank has $260,000 in the account, well below the threshold. The savings account is not a problem for Frank's IRMAA in 2027 based on his current income picture. But it becomes a problem for Margaret as a surviving single filer because the same income picture on a single filer return crosses thresholds much faster. The savings account restructuring is a planning decision that needs to be made before Margaret is making it alone. The time to restructure is while both spouses are alive, filing jointly, and the margins are wide. Account number 5, the taxable brokerage account. Frank and Margaret opened their Vanguard joint taxable brokerage account in 2003. The current balance is $214,000. Most of it is in 3 index funds, a total stock market fund, an international fund, and a small cap value fund that they purchased between 2003 and 2011 and have never sold or significantly rebalanced. The current balance of $214,000 represents decades of compounding on an original investment of approximately $47,000. The unrealized capital gain embedded in the account, approximately $167,000. The cost basis, The original purchase price of those index fund shares is $47,000. If Frank and Margaret sell the entire account today and recognize all gains, the taxable capital gain is $167,000 taxed at long-term rates. At their income level in 2025, long-term capital gains are taxed at 15% federal. State tax in Ohio on long-term gains, approximately 3.75%. Combined, approximately 18.75% on $167,000 of recognized gain, which is $31,312 in capital gains tax. That is not the recommendation. Nobody is saying sell the account and pay $31,000. The point is that the unrealized gain is a liability sitting in the portfolio, a deferred tax obligation that will eventually be recognized either through a sale, through inheritance, or through the step-up in basis that occurs at death. Here is what step-up in basis does for Frank and Margaret if the account is structured correctly. When a spouse inherits an asset, the cost basis of that asset resets to the fair market value on the date of death under Internal Revenue Code, Section 1014. The entire history of appreciation, every dollar of gain that accumulated over 20 or 30 years, disappears at the moment of inheritance. The surviving spouse inherits the account with a fresh basis equal to whatever it was worth on the date of the deceased spouse's death. If they sell the next day, the capital gains tax is zero. For Frank and Margaret's $214,000 brokerage account with $167,000 of embedded gain, if Frank dies first and the account passes to Margaret with the step-up, Margaret inherits the account with a basis of $214,000. No capital gains tax on any of the appreciation that occurred between 2003 and the date of death. But here's the direction problem that the CPA identified when she reviewed their account, the same direction problem that applies to the step-up in basis for brokerage accounts held in common law states like Ohio. In a common law state, a joint tenancy account with a right of survivorship receives a step-up on exactly 50% of its value when one joint tenant dies. The 50% owned by the deceased steps up to fair market value. The 50% already owned by the surviving spouse keeps its original basis because the surviving spouse already owned that portion. There is nothing to inherit. For their $214,000 account, 50% steps up at Frank's death, $107,000. The other half, Margaret's original 50%, retains the proportional original basis of approximately $23,500. Margaret's embedded taxable gain after the step-up, approximately $83,500. At 15% federal plus Ohio state, approximately $15,600 in capital gains tax if she sells after receiving the 50% step-up. The fix the CPA recommended: retitle the brokerage account from joint tenancy into Frank's individual name only before his death, while both spouses are legally capable of executing the transfer. A transfer from joint tenancy to individual ownership is not a taxable event. It does not trigger capital gains. It is a paperwork change at Vanguard that takes 2 business days and a signature. After the retitling, if Frank predeceases Margaret, the entire $214,000 account passes through Frank's estate with a 100% step-up, not 50%. Margaret inherits the entire account with a basis of $214,000, zero capital gains tax on $167,000 of accumulated appreciation. The difference between the joint tenancy outcome and the individually titled outcome, executed now while Frank is alive and healthy, is approximately $15,600 of capital gains tax that either exists or does not exist, depending on which version of the account title is in place on the day Frank dies. The retitling costs nothing. It requires no professional beyond the Vanguard account change process. It creates no taxable event in 2025, and it eliminates a capital gains liability that has been accumulating since 2003. The 2027 relevance. The brokerage account is not generating a direct IRMAA problem because its income, dividends, and any realized gains are currently modest and well below the threshold. But in the years after the required distributions begin and Frank's overall magi is higher, any year in which the brokerage account generates an above-average dividend income or in which a sale is made for any reason, rebalancing, funding a large expense, responding to a market opportunity, can contribute to an income spike that crosses the IRMAA threshold. Reducing the account's contribution to future magi through careful management of the dividend income and the capital gains recognition schedule is part of the same coordinated plan that addresses the IRA conversion and the savings account restructuring. The step-up retitling is this year's action. The dividend management is ongoing, but the retitling is the highest leverage action available in this account because it is available only before death and available without cost or tax consequence right now. Account number 6, the 407B deferred compensation account. This account does not apply to Frank and Margaret directly. It does apply to a very specific group of people watching this video who may not realize they have a distinct planning problem that is different from everything I have covered in the previous 5 accounts. The 457B Deferred Compensation Plan is available to employees of state and local governments and certain tax-exempt organizations, school districts, hospitals, municipalities, county governments, public universities. If you worked for any of these employers and participated in a deferred compensation plan, you have a 457B. And your 457B has a distribution rule that is more flexible than a 401k or 403B in one specific way, and more dangerous in another. The flexibility, unlike a 401k or IRA, a 457B does not impose the 10% early withdrawal penalty for distributions taken before age 59 and a half. If you retire at 55 and need income from your 457B, you can take it penalty-free. This is a genuine advantage and one of the most underused features of the 457B. The danger: the 457B is still subject to required minimum distribution rules at age 73, and the distribution, which is ordinary income, lands directly in MAGI, just like a 401k or IRA distribution. For a government or hospital employee who receives a pension, which creates the same provisional income foundation we described with Frank, adding a 457B distribution on top of the pension and Social Security can push a retiree over the IRMAA threshold in a way that is both predictable and preventable. Here is the specific opportunity the 457B's early access flexibility creates. If you are currently between the ages of 55 and 72 and have retired from a government or hospital employer, and if you have a 457B balance, you are in the window to take voluntary distributions from the 457B before the required distributions begin. At the same time, you are converting the IRA or 401k to Roth. The voluntary 457B distributions are ordinary income, yes, but they are income you control the amount and timing of, and they permanently reduce the balance subject to future required distributions, reducing the future distribution amount and the associated IRMAA cascade. The 2027 implication is direct. For a government or hospital retiree whose 2025 income picture includes a pension plus Social Security plus potential 457B distributions, the combination that most commonly pushes a single filer over the IRMAA threshold after the death of a spouse, the voluntary distribution strategy in 2025, 2026, and 2027 can systematically draw down the 457B at the retiree's preferred tax rate before the required distribution at 73 forces the income into a less favorable year. The action for anyone with a 457B: calculate your current MAGI, identify the IRMAA threshold headroom, and determine how large a voluntary 457B distribution can be taken in 2025 without crossing the next IRMAA tier. If your MAGI is currently $60,000, and the first IRMAA single filer tier begins at $106,000, you have $46,000 of space to draw down the 457B this year at rates and in a year of your choosing, permanently reducing what the required distribution will be at 73 and permanently reducing the future IRMAA pressure from that account. If you are a hospital, school district, or government worker or retiree watching this video and you have a 457B plan, this is the account on this list that your CPA or financial advisor is least likely to have modeled against your IRMAA trajectory. Because the 457B's specific rule set is less familiar than IRA and 401k rules, and the voluntary drawdown strategy before required distributions begin is counterintuitive to the leave the money growing as long as possible guidance most people receive. The counterintuitive truth: a strategic voluntary distribution today at 12% costs less than a forced required distribution at 22% in a year, when your income picture is less favorable and your filing status may be single. My name is Kevin. This channel covers the retirement rules the financial system counts on you not knowing. Subscribe and turn on the bell. These go out every week, and every one of them is built around the same principle you are seeing in this video. The information exists, the forms are free, and the window to act is open right now before the calendar year closes. I want to mention something specifically for anyone who has been watching this video and is looking at their own numbers, their own pension amount, their own IRA balance, their own savings account interest, and is realizing that the IRMAA calculation I described might apply to their 2025 picture. There's a reference I built from everything this channel covers. It is called The Quiet Rules. It walks through the provisional income calculation step by step, the IRMAA threshold tables for 2026 with the specific tier amounts, the Roth conversion bracket math for every filing status and the specific forms, SSA Form 44, IRS Form W4V, and the IRA custodian transfer documentation that implement each strategy. It is not a replacement for your CPA or financial advisor. It is the homework you do so that when you sit down with a professional, you know exactly which calculation you need them to run on your numbers and why. Link is in the description. The guide exists because this video exists, because these conversations are happening in financial planning offices across this country right now for people who knew to ask and are not happening for people who did not. You know to ask. Now, account number 7, the inherited IRA. Frank's mother passed away in 2021 and left him an inherited traditional IRA worth $136,000. Frank has been managing this account, or rather, leaving it alone without managing it, for 4 years. He knows he is supposed to take distributions from it. He has taken some, but he has not been operating under the rules that actually apply to his inherited account, because those rules changed in 2020, and his understanding of them comes from conversations that predated the change before the Secure Act of 2019, which became effective for inherited accounts in 2020. A non-spouse beneficiary who inherited an IRA could stretch the required distributions over their own lifetime, taking small distributions each year and allowing the account to grow for decades. This was the Stretch IRA. It was one of the most powerful intergenerational wealth transfer tools available, and it was used strategically by estate planners to extend tax-deferred growth across 2 or 3 generations. The Secure Act eliminated the Stretch IRA for most non-spouse beneficiaries, replaced it with the 10-year rule. Non-spouse beneficiaries who inherit an IRA on or after January 1st of 2020 must fully distribute the inherited IRA within 10 years of the original owner's death. Frank's mother died in 2021. The 10-year clock started in 2021. The account must be fully distributed by December 31st of 2031, the 10th anniversary year of the inheritance. Frank has taken some distributions in the intervening years, but has not been following a strategy designed to minimize the tax impact of distributing the full $136,000 plus any investment returns by 2031. He has been managing the account as if it were his own IRA, taking distributions when he felt he needed to, rather than when his income picture was most favorable. Here is why 2025 is specifically important for the inherited IRA. The inherited IRA distributions are ordinary income. Every dollar distributed from the account lands in Frank's MAGI in the year of distribution. In 2025, Frank's MAGI from fixed sources, pension and Social Security inclusion, is approximately $59,760. His 12% bracket space, after accounting for the standard deduction and the OBBA senior bonus deduction, is approximately $34,500. He is converting $85,000 from his own IRA as part of the Roth conversion strategy. Both the conversion income and the inherited IRA distribution are ordinary income. They compete for the same bracket space. The coordination challenge. Frank has 3 sources of ordinary income to distribute strategically across the remaining years before the 10-year clock closes in 2031 and before the OBBA window closes in 2028. His own IRA conversion income, his 403B rollover and conversion, and his inherited IRA distributions. The sequence and the annual amounts need to be modeled against his bracket space, the IRMAA thresholds, and the OBBA deduction phase-outs to find the combination that minimizes total tax on all 3 streams simultaneously. The IRS issued regulations in 2024, confirming that for inherited IRAs where the original owner had already started required minimum distributions, the 10-year rule applies and annual distributions are required within the 10-year period, not just a lump sum at the end of year 10. This affects a significant number of inheritors who were planning to wait until year 10 for the full distribution, which would have created a massive 1-year income event. For Frank, who inherited the account when his mother, who was already in her 80s, was presumably taking required minimum distributions, his inherited IRA is subject to the annual distribution requirement within the 10-year window. He needs to be taking a minimum annual amount and must fully distribute by 2031. The optimal strategy for the inherited IRA in Frank's situation: distribute the minimum IRS required annual amount from the inherited IRA in years, where the Roth conversion from his own account is using most of his available bracket space, and take larger distributions in years where the Roth conversion is smaller or where the bracket space is wider. The annual distributions from the inherited IRA are not a choice between taxable and tax-free. All of them will be taxable. The choice is which year and which amount minimizes the rate at which they are taxed. The specific 2027 implication: if Frank distributes the inherited IRA primarily in 2025 and 2026, the 2 years before the Roth conversion is expected to significantly reduce his own IRA's RMD pressure. The inherited account distributions are taxed at 12% in the bracket space he currently has available. If they are pushed to 2028, 2029, 2030, and 2031, years in which his own IRA may be generating required distributions, his 403B rollover may be adding income, and the OBBA senior deduction may no longer be available. The inherited IRA distributions land in a higher income, narrower bracket, higher rate environment. The action this year: calculate the minimum annual distribution required from the inherited IRA to comply with the 10-year rule and compare it to the available 12% bracket space in 2025 after accounting for the Roth conversion plan. Distribute up to the amount that uses the remaining 12% space without crossing the next bracket. Preserve the larger distribution capacity for the years when the own IRA RMD pressure has been reduced by the conversion strategy. This is the coordination that the 3-hour CPA session produced for Frank and Margaret, a year-by-year income allocation schedule that treats all 7 accounts as a single portfolio with a single tax efficiency goal, rather than 7 separate accounts each managed by a different institution with no visibility into what the others are doing. Now let me bring the full picture together with the specific numbers, because until you see all 7 accounts modeled simultaneously, the individual account strategies do not fully convey the magnitude of what is at stake. Frank and Margaret's 2027 outcome in 2 scenarios. Scenario A: no action taken between now and December 31st, 2025. Pension $31,200. Social Security inclusion at 85%, $28,560. Savings account interest on $260,000 at 4.8%, $12,480. IRA required distribution beginning at age 73 in 2027, $27,924. Inherited IRA minimum annual distribution, approximately $18,000, distributed later years at higher rates. 403B distribution from employer plan with limited flexibility, approximately $10,000. Combined to 2027 MAGI, approximately $128,064. At $128,000 MAGI for married filing jointly, still below the $212,000 IRMAA first tier. Frank and Margaret avoid the surcharge in 2027. However, combined federal income tax on all income streams, pension, Social Security inclusion, IRA distribution, savings interest, inherited IRA distribution, approximately $22,600. Ohio state income tax, approximately $2,800. Combined 2027 tax liability, approximately $25,400. After 2027, as Frank's age and the shrinking divisor increase the required distribution each year, and as Margaret eventually files as a single filer with the same income picture but narrower brackets, the annual tax liability escalates. Scenario B: 7 accounts restructured per the CPA's plan before December 31st, 2025. Roth conversion of $85,000 from Frank's IRA executed in 2025 at 12% cost, $10,200. Frank's IRA balance reduced to approximately $655,000. 403B rolled to IRA and added to conversion schedule year 2. Brokerage account retitled to Frank's individual ownership. 0 tax cost, 100% step up at death preserved. Savings account interest managed against bracket headroom. $260,000 balance maintained but restructuring options modeled for future years. Inherited IRA distributions accelerate into 2025 and 2026 bracket space, while 12% room exists. 2027 outcome after the restructuring plan is executed. Frank's IRA required distribution from a reduced balance of approximately $655,000 after 3 years of conversion at $85,000 per year. Approximately $500,000 remaining balance at 73. Distribution approximately $18,868. IRA distribution reduced by $9,000 per year from baseline. Combined 2027 MAGI, approximately $119,000, still below IRMAA tier. Annual federal and state tax, approximately $20,900. Annual tax reduction from the restructuring plan, approximately $4,500 per year every year, starting in 2027. 10-year cumulative tax reduction, approximately $45,000 from 4 years of execution at a total conversion cost of $40,800. Net benefit over 10 years, $4,200 a head, and that calculation excludes the capital gains tax eliminated by the brokerage step-up retitling. $15,600 of capital gains tax that simply does not exist if Frank dies with the individual title brokerage rather than the joint title brokerage. And it excludes the Roth IRA's tax-free growth and Margaret's tax-free inheritance of the converted balance. The total measurable financial benefit of executing the 7-account plan before December 31st of this year versus doing nothing, over $60,000 in reduced taxes and eliminated capital gains obligations, measured only in the first 10 years, only in the items the CPA could calculate at the kitchen table on a Saturday morning. The total cost of execution, $40,800 in Roth conversion taxes paid voluntarily, now at 12%. One form at Vanguard to retitle the brokerage, one form at the 403B plan. Administrator to initiate the rollover, one calculation to optimize the inherited IRA distribution schedule. That is the 7-account plan. Now, the action sequence, 7 steps, 1 per account, in order of urgency for the 2027 deadline. Step 1. This week, log into your IRA custodian account. Find the current balance. Divide by 26.5 to see what your first required distribution would be if you were 73 today. Now add that number to your current pension and Social Security income and run the provisional income formula. Write the combined MAGI down and compare it to the IRMAA threshold for your filing status. That single number tells you how much urgency the IRA restructuring carries for your specific situation. Step 2. This month, if you have a 403B, 401k, or 457B from a previous employer that you have not rolled over into an IRA, initiate the rollover process this month. Request the rollover paperwork from the plan administrator. The process takes 2 to 4 weeks. There is no income event. The account transfers intact. This is the foundational step that enables the conversion coordination in steps 3 and 4. Step 3. Before September, calculate your 2025 Roth conversion target. The formula. Identify your current MAGI from fixed sources. Pension, any part-time income, dividend income, subtract from the top of your 12% bracket. $94,300 for married filing jointly in 2026. And the remainder is your maximum 12% conversion space for this year after accounting for the senior bonus deduction. Convert up to that amount by December 31st. The conversion must happen in the calendar year to count toward 2025 taxes. Step 4. Before September. If you have a joint taxable brokerage account with significant unrealized gains, consult with your CPA about retitling the account into the name of the spouse who is more likely to predecease the other, the older spouse, or the one with the less favorable health outlook. The retitling costs nothing. The capital gains tax it prevents can be substantial. This is the highest leverage, zero-cost action on this list. Step 5. Before October. Call your Medicare Part D plan and ask for your year-to-date out-of-pocket total toward the $2,000 annual cap. If you are approaching the cap, fill every prescription you need before December 31st. If the cap has been reached and you have been charged copays since, request a coverage determination review. Step 6. Before November. If you have an inherited IRA, calculate the minimum annual distribution required by the 10-year rule and compare it to your remaining 2025 bracket space. If space is available above the minimum, consider accelerating the O2 distribution into 2025 rather than leaving it for years with less favorable income pictures. Every dollar distributed at 12% now is a dollar that will not be distributed at 22% in 2029 or 2030. Step 7. Before December 31st, if your 2025 MAGI, including all 7-account income sources, is approaching the IRMAA threshold for your filing status, review whether any year-end income actions can reduce MAGI below the threshold. Qualified charitable distributions from an IRA, for example, reduce MAGI dollar for dollar by routing the distribution directly to charity without passing through adjusted gross income. The 2026 QCD limit is $111,000 per person. All 7 steps together represent the plan the CPA outlined for Frank and Margaret on a Saturday morning in Dublin, Ohio. 3 hours, $420. Now, pretty darn insane. Coordinated strategy across 7 accounts that are currently managed by 4 different institutions, none of which have visibility into what the others are doing, and none of which have any obligation to show Frank and Margaret how the accounts interact. The interaction is where the money is. The interaction is what this video exists to show you. Let me come back to Frank and Margaret one final time. After the Saturday session in Dublin, Frank and Margaret spent 2 weeks going through the plan with each other, asking whether it made sense, whether they understood each step, whether they trusted the process. Margaret was skeptical of the Roth conversion at first. She had been told by a neighbor that Roth conversions were for younger people, and that at their age, paying the tax now instead of later did not make sense. Frank called the CPA back with that question. She ran a 45-year projection from now to age 100, accounting for Margaret's statistical likelihood of surviving Frank by several years, showing the cumulative tax cost on all income streams in both scenarios, converting now versus not converting. The answer was not close. At every point on the projection where Margaret was filing as a single filer, the years most likely to represent the majority of her retirement, the non-conversion scenario cost dramatically more in federal taxes per year than the conversion scenario. The break-even on the conversion cost occurred in the 3rd year of required distributions. Every year after the break-even, the conversion scenario put money back. Margaret asked the CPA one more question. She asked, "Why didn't our broker show us this?" The CPA paused before answering. She said, "Because showing you this requires knowing what all 7 of your accounts are doing simultaneously and modeling them against each other in a way that your broker does not do. Not because he does not care, because his process is to review each account individually and he is not compensated to do the coordinated tax planning that would require him to see all 7 together." She said, "The accounts are separate. The tax consequences are not. Coordinated tax planning that would require him to see all 7 together." She said, "The accounts are separate. The tax consequences are not." That is the sentence Frank told me he replays constantly. Not the $12,000 annual number, not the 45-year projection, not the step-up basis calculation. That sentence, "The accounts are separate. The tax consequences are not." Your traditional IRA, your 401k, your pension, your savings account, your brokerage, your 457B, your inherited IRA, each managed by a separate institution, each with its own statement, its own advisor relationship, its own set of rules. None of those institutions is looking at the others. None of them is calculating what happens to your 2027 Social Security deposit when all of them generate income in the same year. None of them knows what the combined MAGI is. None of them knows whether the IRMAA threshold is being approached. You know now. The window is still open. December 31st is the deadline. The accounts are separate. The tax consequences are not. Share this video with one person over 60 who has a traditional IRA or 401k and has never had someone sit down and model all their accounts against each other in the same room on the same afternoon. One person, one conversation, one Saturday morning with a fee-only CPA, the kind who charges a flat fee and receives 0 commission from any product they recommend, can change what January 2027 costs them. The NAPIFA directory at napifa.org lets you search for fee-only fiduciaries by zip code at no charge. The initial consultation to review a 7-account retirement portfolio typically costs $300 to $600. The value of the tax cascade it can prevent, as the numbers in this video demonstrate, is measured in tens of thousands of dollars over the first decade alone. Subscribe and turn on the bell. The next video on this channel covers the 5 amended return opportunities, the forms the IRS allows you to file retroactively to recover taxes overpaid in prior years. Some go back 3 years. Some have windows that are actively closing. Most retirees who are owed money never file because they do not know the window is open. You will know the exact window, the exact form, and the exact dollar amount attached to each one before that video ends.